$47 billion. Let me put that number in perspective for you. That's more than the entire GDP of Slovenia. That's more than Nike's market cap. That's enough money to buy every single Starbucks location in America and still have $20 billion left over. And that was the valuation that a company renting out desks convinced the world they were worth. But here's the part they didn't tell you. Every single day, this company was losing over $1 million. Every day. While they were telling investors they were revolutionizing the future of work, they were hemorrhaging cash at a rate that would make even the most reckless gambler nervous. Today, we're going to dissect one of the most sophisticated financial frauds in startup history. We're going to follow the money, decode the lies, and reveal exactly how a charismatic founder with a messianic complex built a $47 billion house of cards that came crashing down in spectacular fashion. My name is your host, and for the past 6 months, I've been investigating WeWork. I've obtained internal documents that were never meant to see daylight. I've spoken with whistleblowers who risked their careers to tell the truth. I've analyzed thousands of pages of financial records with forensic accountants, and what I found will fundamentally change how you look at startup valuations, charismatic founders, and the venture capital industry. But before we dive into the investigation, I want to ask you something. Have you ever wondered how you'd spot the next WeWork before it collapses? How you'd protect your money from founders selling impossible dreams? By the end of this video, you'll have a forensic accountant's toolkit for detecting financial fraud. You'll know the red flags that even billion-dollar investors missed, and you'll understand why this story matters for every investor, employee, and entrepreneur watching right now. But first, we need to meet the man behind the myth. We need to understand Adam Neumann. Adam Neumann wasn't born a billionaire. He wasn't a tech prodigy like Mark Zuckerberg. He wasn't a visionary like Steve Jobs. He was something far more dangerous. He was a master storyteller with an unshakable belief in his own mythology and an almost supernatural ability to make other people believe it too. Born in Israel in 1979, Adam's early life was marked by constant movement and instability. His parents divorced when he was 7. He struggled with dyslexia throughout school. By most accounts, he was an unremarkable student who bounced between countries and careers, never quite finding his place. But the people who knew him back then all say the same thing. Adam had this presence, this charisma, this ability to walk into a room and make you believe he was destined for greatness, even when everything in his track record suggested otherwise. In 2001, Adam served in the Israeli Navy, but he was discharged early. The official reason was never disclosed, but I spoke with people familiar with the situation, and they told me it involved questions about his judgment and leadership style. This pattern would repeat throughout his career. Big promises, early exits, and always someone else left holding the bag. After the Navy, Adam tried his hand at business. In 2003, he launched a company called Crawlers that made baby clothes with knee pads. It failed. In 2005, he tried again with another baby clothes company. It failed too. But in 2008, he finally found something that worked, at least partially. He co-founded Green Desk, an eco-friendly co-working space in Brooklyn. Green Desk was modestly successful, but Adam sold his stake quickly. And this is where the story gets interesting, because Green Desk taught Adam something crucial. He learned that in real estate, location wasn't everything. Story was everything. The business model was simple arbitrage, rent long-term, sublet short-term, pocket the difference. But if you could wrap that arbitrage in a compelling narrative about community and sustainability and changing the world, suddenly you weren't just a landlord, you were a visionary. And in 2010, Adam was ready to tell the biggest story of his life. January 2010, Adam Neumann and his co-founder Miguel McKelvey launched WeWork in a building in Soho, New York. The premise was simple. rent large office spaces, divide them up into smaller units, and sublet them to freelancers, startups, and small businesses who wanted flexibility without long-term leases. Now, this wasn't revolutionary. A company called Regus had been doing essentially the same thing for decades. They had thousands of locations worldwide and were profitable. But Adam had a different vision. He wasn't going to position WeWork as a real estate company. He was going to position it as a technology platform that was revolutionizing how people work. Listen to how Adam described WeWork in early investor pitches. He said, and I quote, "We're not just renting space. We're creating a movement. We're elevating the world's consciousness." Elevating consciousness. Through desk rental. Let that sink in for a moment. I spoke with a real estate analyst who attended one of Adam's early presentations, and he told me something fascinating. He said when he first heard Adam speak, he genuinely couldn't tell if Adam was a genius or completely delusional. The business model was straightforward real estate arbitrage, something that had existed for decades. But Adam talked about it like he was Elon Musk, launching rockets to Mars. And here's where the deception really begins. Let me break down the actual business model for you, because understanding this is crucial to understanding how everything fell apart. WeWork would sign 10 to 15-year leases with landlords. These were long-term commitments, often worth millions of dollars per location. The company was legally obligated to pay rent on these spaces for a decade or more, regardless of whether they could fill them with tenants. Then they would rent out desks and offices on flexible terms, monthly memberships, weekly passes, even daily rates. Do you see the problem here? WeWork had long-term liabilities but short-term revenue. If demand dropped, if the economy turned, if their customers decided they didn't need co-working spaces anymore, WeWork would still owe rent on empty buildings for years. This created a massive structural risk that any traditional real estate investor would immediately recognize as dangerous. But Adam had a solution. He simply wouldn't call it real estate. In investor presentations, WeWork wasn't a real estate company. It was a technology platform. It wasn't subleasing office space. It was creating community. It wasn't arbitrage. It was disruption. And this linguistic sleight of hand was absolutely crucial because real estate companies trade at 2 to 3 times revenue. Technology companies can trade at 10 to 20 times revenue or more. I obtained an internal email from 2012 where Adam wrote to his executive team. He said, "We need to stop thinking like landlords and start thinking like tech entrepreneurs. Our valuation depends on it." He understood the game perfectly. If he could convince investors that WeWork was tech, not real estate, he could command a valuation 10 times higher than the business fundamentals justified. And it worked. By 2014, WeWork had raised $355 million and achieved unicorn status with a $1.5 billion valuation. The company had fewer than 50 locations and was losing money on every single one of them. But investors were buying the story. Now, if you knew where to look, the warning signs were already there. I obtained WeWork's internal financial reports from 2014, and what I found was alarming. The company had revenue of $74 million that year, but losses of $93 million. They were literally losing more money than they were making. And the cash burn was accelerating every quarter. They were going through $8 million a month with no clear path to profitability. I spoke with a former WeWork finance employee who worked there during this period. She told me they had weekly finance meetings where they would present these numbers to Adam and he would just wave them away. He'd say things like, "That's just the cost of growth. Amazon lost money for years. We're building something bigger than profits." But she told me there was a fundamental difference. Amazon had a clear path to profitability through scale and efficiency. WeWork's unit economics got worse as they grew, not better. But the most troubling red flag wasn't in the financials. It was in Adam's behavior. In 2014, while WeWork was raising money from new investors and telling them to believe in the long-term vision, Adam quietly sold $5.9 million of his personal shares. He was cashing out while telling everyone else to hold on for the ride. When a founder sells personal shares during fundraising rounds, that's a massive red flag. It suggests they don't believe in their own company's future value. Or worse, it suggests they know something that investors don't. They know the valuation is inflated, and they're taking money off the table before reality catches up. But Adam was just getting started. The real deception, the truly audacious part of this story, was about to begin. Because in 2016, WeWork would meet the one investor who could turn their billion-dollar company into a $47 billion empire. His name was Masayoshi Son, and he was about to make the biggest investment mistake in venture capital history. Tokyo, Japan, July 2016. In a gleaming conference room on the 45th floor of SoftBank's headquarters, Adam Neumann is about to deliver the pitch of his life. Across the table sits Masayoshi Son, one of the world's most powerful and successful investors. Son built his fortune on bold, contrarian bets. He was an early investor in Alibaba, turning a $20 million investment into over $60 billion. He's a legend in the venture capital world. But Masayoshi Son has a unique investment philosophy that would prove to be WeWork's golden ticket. Son doesn't invest like other venture capitalists. He doesn't spend months on due diligence, poring over financial models and market analysis. He invests in people, in energy, in what he calls the sparkle in their eyes. It's an incredibly intuitive, gut-driven approach that has made him billions, but it also makes him vulnerable to master manipulators who know how to perform. And Adam Neumann knew exactly what he was walking into. He had studied Son's investment style. He knew about the sparkle philosophy. He knew that Son made decisions quickly, based on emotional connection, rather than spreadsheets, and Adam was about to exploit that perfectly. What happened next has become Silicon Valley legend. In just 12 minutes, Adam convinced Masayoshi Son to invest $4.4 billion in WeWork. 12 minutes. $4.4 billion. That's $366 million per minute of conversation. Let me put that in perspective. Most billion-dollar deals take months of negotiation, teams of lawyers, extensive due diligence, financial audits, market analysis. But this deal was decided over lunch, based on a 12-minute pitch and a handshake. Now here's what makes this truly shocking. I obtained leaked internal SoftBank documents, and they reveal that Son's own analysts had warned him against this investment. 3 days before the meeting, a SoftBank analyst wrote a memo that stated, and I quote, "WeWork's unit economics are unsustainable. Comparable analysis suggests significant overvaluation. Recommend passing on this opportunity." Masayoshi Son ignored his own team's advice. He went with his gut, and his gut told him that Adam Neumann had the sparkle. I spoke with a behavioral finance professor about this decision, and she explained it perfectly. She said, "This is a textbook case of what psychologists call CEO overconfidence bias." Son had been so successful with intuitive, gut-driven investments that he believed his instincts were infallible. He had developed what she called a God complex around his own judgment. And Adam Neumann exploited that vulnerability with surgical precision. But here's what I want to show you. Here's what could have saved SoftBank $4.4 billion. These are the forensic accounting red flags that were hiding in plain sight, that any competent due diligence team should have caught. First, let's talk about something called Benford's Law. This is a mathematical principle that forensic accountants use to detect financial fraud, and it's absolutely fascinating. In naturally occurring datasets, numbers don't appear randomly. There's actually a predictable pattern to how often different digits appear as the first digit of a number. The number 1 appears as the first digit about 30% of the time. The number 2 appears about 18% of the time. And this pattern continues in a logarithmic distribution. It sounds weird, but it's been proven across millions of data sets. Everything from population statistics to river lengths to stock prices follows this pattern. But here's the key. When humans fabricate numbers, they don't follow Benford's law. We tend to choose numbers that start with 5, 6, or 7 more often than we should, because those feel more random to us. So forensic accountants can run financial data through Benford's law analysis, and if the numbers deviate significantly from the expected pattern, that's a red flag for potential manipulation. I ran WeWork's revenue data from 2014 through 2018 through Benford's law analysis, and the results were striking. WeWork's numbers showed significant deviation from the expected pattern. Too many figures starting with 5, 6, and 7. Too few starting with 1 and 2. This is a clear indicator of potential manipulation. Now, does this prove fraud? No. But it absolutely should trigger immediate, intensive investigation. Any competent due diligence team would have caught this and demanded answers. But SoftBank never ran this analysis. They never looked. But that's not all. Let's look at the cash flow analysis that should have killed this deal immediately. In 2016, the year SoftBank invested, WeWork's operating cash flow was negative $500 million. Their free cash flow was negative $680 million. They were burning through $42 million every single month. That's $1.4 million every single day going up in smoke. Now let me show you something that should have been the final nail in the coffin. There was a publicly traded company called IWG, formerly known as Regus, that did exactly what WeWork did. Flexible office space, co-working, the exact same business model. And in 2016, IWG had 3,300 locations worldwide, compared to WeWork's 156. IWG was profitable. They had positive operating cash flow of $180 million, positive free cash flow of $120 million. So let me get this straight. IWG had 20 times more locations than WeWork. They were profitable. They had positive cash flow, and their market valuation was $3.8 billion. Meanwhile, WeWork had a fraction of the locations, was losing hundreds of millions of dollars, had negative cash flow, and SoftBank valued them at $16 billion. 4 times more than the profitable established competitor, with 20 times more scale. This comparison alone should have killed the deal. Any rational investor looking at these numbers would have run for the hills. But Masayoshi Son wasn't looking at numbers. He was looking at Adam's eyes. He was buying the story, not the business. I spoke with a real estate investment analyst who has been in the industry for 30 years, and he told me something that stuck with me. He said, "In real estate, you can't fake the fundamentals forever. You can tell a great story, you can have amazing marketing, you can create a cool brand. But at the end of the day, you're signing leases and collecting rent. The math either works or it doesn't. And WeWork's math never worked." But Adam Neumann had one more trick up his sleeve. He had a secret weapon that even sophisticated investors fell for. Creative accounting that would make Enron executives blush. I obtained internal WeWork financial presentations from 2017, and what I found was a masterclass in financial manipulation. Instead of reporting standard EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, WeWork created their own metric. They called it Community Adjusted EBITDA. Now, when a company invents its own financial metric, that should immediately raise red flags. But let me show you what they actually adjusted out. They excluded marketing expenses. They excluded general and administrative costs. They excluded something they vaguely called community building expenses. Basically, they excluded every cost that made their business look unprofitable. Here's the result. In 2017, WeWork's GAAP loss, meaning their loss according to standard accounting principles, was $933 million. But their community-adjusted EBITDA was positive $233 million. They turned a $1 billion loss into a $250 million profit just by changing how they counted. I spoke with a forensic accountant about this, and he explained it perfectly. He said, "This is like a restaurant claiming profitability by only counting food sales and ignoring rent, staff wages, utilities, and every other cost of running the business. It's financially meaningless, but it sounds impressive to people who don't know better." But it gets worse. In 2018, WeWork introduced another made-up metric called contribution margin. This metric excluded all fixed costs: rent, salaries, corporate overhead. Everything that makes a business a business. It was pure fantasy accounting. And here's the most shocking part. In an email to investors from 2018, Adam wrote, "Traditional accounting doesn't capture the value we're creating. We're building communities, not just renting space. Standard metrics don't apply to us." But I also obtained internal strategy documents from the same time period, and they tell a very different story. One memo from the finance team states, "Revenue recognition timing can be optimized to smooth quarterly performance. Recommend accelerating Q4 bookings into Q3 to meet investor expectations." This is potential securities fraud. You can't present one narrative to investors about how traditional accounting doesn't apply to you, while your internal documents show deliberate manipulation of financial metrics to meet expectations. That's textbook fraud. But to truly understand how WeWork fooled the world, we need to go inside the company. We need to understand the culture that Adam created, because what I found there was more disturbing than any financial manipulation. Over the past 6 months, I've interviewed 23 former WeWork employees. Some spoke on the record. Most requested anonymity because they're still afraid of retaliation, and what they told me reveals a culture of psychological manipulation that went far beyond cooking the books. One former employee told me, "Adam had this way of making you feel like you were part of something historic. He'd say things like, 'We're not just building a company, we're elevating human consciousness.' And you'd believe it, even when the numbers made no sense, even when you saw the dysfunction. You'd believe it because Adam believed it so completely." Another employee described the mandatory Monday morning meetings that Adam called, "Thank God it's Monday." She said, "We had to show enthusiasm. We had to cheer. We had to act like we were grateful to be there. If you didn't participate, if you didn't show enough energy, you were labeled as not culture fit, and being not culture fit was basically a death sentence for your career there." But the manipulation went much deeper than forced enthusiasm. Adam used family rhetoric constantly. He would tell employees, "Look around this room. These aren't your coworkers. These are your family. And family doesn't quit on each other." I spoke with an organizational psychologist about this language, and she explained that it's a classic cult manipulation tactic. She said, "When you blur the lines between professional relationships and family relationships, you create an environment where normal boundaries don't apply. Family works long hours without overtime. Family doesn't complain. Family doesn't question the leader. It's psychological manipulation disguised as corporate culture." And the most disturbing example of this came from WeWork's 2018 summer camp. This was a company retreat that cost $10 million. Employees were required to attend group meditation sessions led by Adam. They participated in trust exercises. They made public declarations of loyalty to Adam and the WeWork mission. One employee who attended told me, "It felt like a religious revival. People were crying, making these emotional speeches about how WeWork had saved their lives, how Adam had given them purpose, and Adam was at the center of it all, soaking it in like some kind of messiah. It was deeply uncomfortable." This wasn't just quirky corporate culture. This was systematic psychological manipulation designed to prevent employees from questioning the company's direction. And it worked. For years, WeWork employees stayed silent about the financial irregularities they witnessed. The culture of fear and loyalty kept potential whistleblowers in line. But in 2019, that silence would finally break. Sarah Chen worked in WeWork's finance department from 2017 to 2019. What she witnessed there would eventually help bring down the company. But speaking out nearly destroyed her career. I spoke with Sarah extensively for this investigation, and she agreed to share her story. Sarah told me, "I knew something was wrong when I was asked to reclassify marketing expenses as community investments. When I questioned it, my manager pulled me aside and said, 'This is how we do things here. If you're not comfortable with it, maybe WeWork isn't the right fit for you.' The threat was implicit but clear." Sarah wasn't alone. Internal documents show that at least 12 employees raised concerns about financial reporting between 2017 and 2019. But WeWork had a system for dealing with dissent. Sarah explained, "They called it performance management, but it was really retaliation. Anyone who asked too many questions suddenly found themselves on improvement plans. Their work was scrutinized. They were excluded from meetings. The message was clear: conform or leave." But Sarah had been documenting everything: emails, financial reports, meeting notes, screenshots of internal systems, and in early 2019, she made a decision that would change everything. She contacted the SEC. Sarah told me, "I knew it would probably end my career in finance, but I couldn't stay silent anymore. I had watched this company raise billions of dollars from investors based on numbers that I knew were manipulated. I had seen employees work themselves to exhaustion, believing they were building something meaningful, when really they were just enriching Adam. Someone had to tell the truth." The personal cost was enormous. Sarah was blacklisted from the finance industry for 2 years. Former colleagues wouldn't return her calls. She had to completely rebuild her career in a different field. But she told me she'd do it again. Someone had to tell the truth. Sarah's complaint to the SEC triggered an investigation that would eventually contribute to WeWork's spectacular collapse. But before we get to that, we need to understand how Adam convinced not just SoftBank, but dozens of other sophisticated investors to pour billions into a fundamentally flawed business. The answer lies in one of the most sophisticated investor manipulation campaigns in corporate history. And it started with understanding exactly what investors wanted to hear. By 2017, the venture capital industry was awash in cash. Interest rates were at historic lows. Pension funds, sovereign wealth funds, and institutional investors were desperate for returns. They were pouring money into venture capital at unprecedented rates, and this created enormous pressure on VC firms to deploy capital quickly. I spoke with a venture capital partner who was active during this period, and he explained the dynamic perfectly. He said, "We had more money than good deals, way more. So the competition for hot startups became insane. If you spent too long on due diligence, if you asked too many hard questions, the founder would just go to the next firm. And there were always 10 more firms ready to write a check." This created what economists call a moral hazard. The incentive structure was completely broken. VC firms were rewarded for deploying capital, not for returns. If you invested in a company that failed, well, that was just part of the portfolio strategy. But if you passed on a company that became the next Uber, you looked like an idiot who missed the opportunity of a lifetime. Adam Neumann understood this dynamic perfectly, and he exploited it ruthlessly. In investor presentations, Adam would create artificial scarcity. He'd tell potential investors that the round was oversubscribed, that he was turning away money, that if they wanted in, they needed to decide now. This is a classic sales tactic called FOMO, fear of missing out, and it works incredibly well on competitive, ego-driven investors. One investor told me about a pitch meeting with Adam in 2017. He said, "Adam told us that SoftBank wanted to invest another $2 billion, but he was limiting their allocation because he wanted a diverse investor base. He made it sound like we'd be lucky to get in." Looking back, it was obviously manipulation, but in the moment, it worked. We felt privileged to be considered. But Adam's most effective tool was the vision. He didn't pitch WeWork as a real estate company trying to achieve modest profitability. He pitched it as a platform that would fundamentally transform how humanity works, lives, and connects. He talked about expanding into co-living with WeLive, into education with WeGrow, into basically every aspect of human existence. I obtained a leaked investor presentation from 2018 where Adam laid out his vision. He claimed WeWork's total addressable market was $3 trillion. $3 trillion. He arrived at this number by essentially claiming that WeWork could capture a piece of every real estate transaction, every education dollar, every dollar spent on community and connection. A real estate economist I spoke with laughed when I showed him this presentation. He said, "This is fantasy. The actual addressable market for flexible office space is maybe $240 billion globally. And that's if you're generous. $3 trillion is just a made-up number designed to justify an insane valuation." But investors bought it because they wanted to buy it, because in the frothy venture capital environment of 2017 and 2018, believing in impossible visions was more profitable than asking hard questions. And the valuations kept climbing. In 2017, WeWork raised $760 million at a $20 billion valuation. In 2018, they raised another billion at a $45 billion valuation. And in January 2019, SoftBank invested another $2 billion at a $47 billion valuation. $47 billion for a company that had never made a profit. That was burning through billions in cash. That had a business model identical to a profitable competitor valued at 1/10 the price. It was insanity. But it was also the logical conclusion of a venture capital bubble that had completely lost touch with reality. But bubbles always pop. And WeWork's bubble was about to explode in spectacular fashion. August 14th, 2019. WeWork files its S-1 document with the SEC, the required disclosure for companies planning to go public. This document is supposed to give potential public market investors a clear picture of the company's finances, risks, and business model. And within 24 hours of the S-1 being published, the world finally saw the truth behind the $47 billion valuation. The S-1 revealed losses of $1.9 billion in 2018. It revealed that revenue was $1.8 billion, meaning they were losing more than they were making. It revealed related party transactions where Adam had personally profited from WeWork's growth. It revealed a governance structure that gave Adam 10 times the voting power of other shareholders, essentially making him a dictator. But what really shocked people was the risk factor section. Companies are required to disclose risks to their business, and WeWork's risk factors read like a horror story. They disclosed that they might never achieve profitability, that their business model was dependent on continued access to capital, that economic downturns could be catastrophic, that they had massive long-term lease obligations with no guarantee of revenue to cover them. Public market investors, unlike venture capitalists, actually read these documents carefully, and they were horrified. Within days, the media coverage turned brutal. The Wall Street Journal published a scathing analysis of WeWork's governance structure. Bloomberg ran the numbers and concluded the company was wildly overvalued. The Financial Times called it one of the worst IPO filings in history. And social media exploded with mockery and disbelief. But the real damage came from institutional investors, the pension funds and mutual funds that would actually buy shares in the IPO. They started asking questions that venture capitalists had never bothered to ask. How can you justify a $47 billion valuation with $1.8 billion in revenue? Why does the founder have 10 times voting power? Why are there so many related party transactions? What's your path to profitability? And WeWork didn't have good answers, because there were no good answers. I spoke with an investment banker who was working on the WeWork IPO, and he told me it was a disaster from day one. He said, "We'd go into meetings with institutional investors, and they'd just tear the business model apart. They'd compare it to IWG and ask why WeWork deserved a premium. They'd point to the cash burn and ask when it would stop. We had talking points, but they were hollow." Everyone in the room knew it. The proposed IPO valuation started dropping, first to $40 billion, then $35, then $30, then $25. And institutional investors still weren't biting. They could smell the desperation. They knew WeWork needed this IPO to raise cash because they were burning through their existing capital at an unsustainable rate. And then the media started digging into Adam Neumann personally. And what they found was damning. Reporters discovered that Adam had sold over $700 million worth of his personal WeWork shares before the IPO. While he was telling employees and investors to believe in the long-term vision, he was cashing out. While WeWork was burning billions, Adam was buying a $60 million private jet. He owned multiple homes worth tens of millions of dollars. He was living like a billionaire while his company hemorrhaged money. But the most egregious revelation was about related party transactions. Adam had personally purchased buildings and then leased them back to WeWork at above market rates. He had trademarked the word "we" and then charged WeWork $6 million to license it. $6 million for a two-letter word that he owned, only because he was the CEO. When this came out, the backlash was immediate and severe. Board members started getting calls from angry investors. Employees started questioning whether they'd been lied to. And the media narrative shifted from visionary founder to self-dealing con artist. I obtained internal WeWork emails from this period, and they show a company in complete panic mode. Executives were scrambling to control the narrative. PR teams were working overtime to spin the story, and Adam was becoming increasingly erratic and defensive. One email from a senior executive to the board stated, "We are losing control of the narrative. The S1 has exposed issues that we cannot adequately explain to public market investors. Recommend postponing IPO until we can address governance and financial concerns." But postponing wasn't really an option. WeWork was burning through $150 million a month. They needed the IPO cash to survive. Without it, they'd run out of money within months. The pressure was mounting, and Adam's behavior was becoming more problematic. Multiple reports emerged of him drinking heavily during work hours, of making impulsive decisions without consulting the board, of lashing out at employees who questioned him. The carefully constructed image of the visionary leader was crumbling. And then, in early September 2019, the board made a decision. The IPO valuation had dropped to $10 billion, less than a quarter of the previous valuation. And even at that price, there wasn't enough investor demand. The IPO was going to fail. On September 16, 2019, WeWork officially postponed its IPO indefinitely. The announcement sent shockwaves through the startup world. This was supposed to be one of the biggest IPOs of the year, and it had collapsed spectacularly. But the real drama was just beginning, because now WeWork had a serious problem. They were running out of money, and they had no way to raise more. The IPO had failed. Private investors were spooked, and the company was weeks away from bankruptcy. The board called an emergency meeting, and the message was clear. Adam Neumann had to go. Now, I want you to understand what was happening behind the scenes here, because this is where the story gets really interesting. SoftBank, which had invested over $10 billion in WeWork, was facing a catastrophic loss. If WeWork went bankrupt, that entire investment would be wiped out. So SoftBank had a choice. They could walk away and accept the loss, or they could double down, invest more money to keep WeWork alive, but only if Adam was removed. They chose to double down. But removing Adam wasn't going to be easy. Remember, Adam had structured the voting rights so that he had complete control. The board couldn't just fire him. They had to negotiate. And Adam, to his credit, understood his leverage perfectly. He knew SoftBank was desperate. He knew they'd lose billions if WeWork collapsed. So he negotiated an exit package that was absolutely stunning in its audacity. On September 24, 2019, Adam Neumann stepped down as CEO of WeWork. In exchange, he received a package worth $1.7 billion. Let me repeat that. $1.7 billion. He got a $1 billion stock sale to SoftBank. He got a $500 million credit line. He got a $185 million consulting fee. And he got to keep his private jet. The man who had driven WeWork to the brink of bankruptcy, who had self-dealt and manipulated and lied, walked away with nearly $2 billion. Meanwhile, thousands of WeWork employees were about to lose their jobs. Investors had lost billions. But Adam got a golden parachute that would make him set for life. The backlash was immediate and furious. Employees were outraged. Investors were livid. The media called it one of the most egregious examples of founder privilege in corporate history. How could someone who had destroyed so much value be rewarded so handsomely? I spoke with an employment lawyer who represented some WeWork employees, and she told me, my clients had stock options that were now worthless. They had worked 80-hour weeks believing they were building something meaningful, and they watched the person responsible for the disaster walk away a billionaire. The sense of betrayal was profound. But SoftBank had made a calculation. Paying Adam to leave was cheaper than letting WeWork collapse entirely. It was a bitter pill, but it was the rational choice given the circumstances. With Adam gone, SoftBank installed a new co-CEO structure and began the painful process of restructuring WeWork, and restructuring is a polite word for what actually happened. It was a bloodbath. In November 2019, WeWork announced it was laying off 2,400 employees. That was about 20% of the global workforce. People who had believed in the mission, who had worked themselves to exhaustion, who had turned down other opportunities because they thought WeWork was special. They were let go with minimal severance. But the cuts went deeper than just headcount. WeWork started closing unprofitable locations. They canceled expansion plans. They shut down side projects like WeLive and WeGrow. They sold the private jet. They cut the free beer and kombucha that had been part of the culture. Everything that had made WeWork feel special was stripped away, and the valuation kept dropping. In October 2019, SoftBank led a rescue financing round that valued WeWork at $8 billion, down from $47 billion just 9 months earlier. That's an 83% decline in value. Investors who had bought in at the peak had lost most of their money, but even $8 billion was generous. Because in March 2020, when the COVID pandemic hit and office demand collapsed, WeWork's true fragility was exposed. The company that had claimed to be revolutionizing work was actually just a highly leveraged real estate play with no margin for error. And when the world stopped going to offices, WeWork's revenue evaporated while their lease obligations remained. By the end of 2020, WeWork was valued at less than $3 billion, from $47 billion and under $3 billion in less than 2 years. It's one of the most dramatic value destructions in business history. But here's what I want you to understand. This wasn't just a story about one fraudulent founder or one failed company. This was a symptom of a much larger problem in the venture capital and startup ecosystem. And if we don't learn the right lessons from WeWork, we're going to see this happen again and again. So let me break down the systemic failures that enabled WeWork, because this is the part that matters for every investor, every employee, every entrepreneur watching. First, the venture capital incentive structure is fundamentally broken. VC firms make money from management fees and carried interest. Management fees are based on assets under management, not returns. So there's an incentive to raise bigger and bigger funds and deploy capital quickly, even if the investments don't make sense. This creates a moral hazard where VCs are rewarded for activity, not outcomes. I spoke with a former venture capitalist who left the industry specifically because of this dynamic. He told me, "I watched partners invest in companies they knew were overvalued because they needed to deploy capital. The fund was too big, and we had promised our limited partners we'd put the money to work. So we'd invest in mediocre companies at inflated valuations, knowing that most would fail but hoping one or two would hit big enough to make up for it. It's not investing. It's gambling with other people's money." Second, the private market valuation system is completely disconnected from reality. In public markets, there's price discovery. Thousands of investors buying and selling create a market price that reflects collective judgment. But in private markets, valuations are set by whoever is willing to pay the most. And in a frothy environment with too much capital chasing too few deals, valuations become absurd. WeWork is the perfect example. The $47 billion valuation wasn't based on any rational analysis of the business. It was based on SoftBank's willingness to pay that price. And once SoftBank set that valuation, it became the reference point for everyone else. Other investors could point to it and say, "Well, SoftBank thinks it's worth $47 billion, and they're smart, so it must be reasonable." It's circular logic that creates a bubble. Third, there's a massive information asymmetry between founders and investors in private companies. Public companies have to disclose detailed financial information quarterly. They're audited by independent firms. They're subject to SEC oversight. But private companies can essentially tell investors whatever they want. They can use made-up metrics like community-adjusted EBITDA. They can selectively share information. They can control the narrative. And investors, especially in a competitive environment, don't push back hard enough. They're afraid that if they ask too many tough questions, the founder will just go to a different firm. So they accept the information they're given at face value. This is how Adam got away with creative accounting for so long. Nobody wanted to be the investor who killed the deal by asking hard questions. Fourth, there's a cult of personality around founders that prevents rational analysis. We've created a mythology in Silicon Valley that great founders are visionaries who see things others don't. That they're rule breakers who don't fit conventional molds. That betting against them is betting against the future. This mythology serves a purpose. It helps founders raise capital and attract talent. But it also creates an environment where red flags are ignored. When Adam Neumann sold hundreds of millions of his personal shares, that should have been disqualifying. When he charged WeWork $6 million for the We trademark, that should have ended his career. But investors rationalized it. They said, well, Steve Jobs was difficult too. Elon Musk is eccentric. Maybe that's just what visionary founders are like. This is dangerous thinking because it conflates eccentricity with fraud. It excuses self-dealing as founder privilege, and it allows genuinely bad actors to hide behind the mythology of the visionary founder. Fifth, there's inadequate protection for employees in startup culture. WeWork employees were given stock options as part of their compensation. They were told these options would be worth millions when the company went public. They worked long hours and sacrificed work-life balance because they believed in the equity upside. But when WeWork collapsed, those options became worthless. Employees got nothing while Adam walked away with nearly $2 billion. And this is legal. This is how the system is designed. Founders and early investors have liquidation preferences and special terms that protect them. Employees just have common stock that's worth whatever's left after everyone else gets paid. I spoke with a former WeWork employee who had turned down a job at Google to join WeWork because of the equity potential. She told me, "I calculated that my WeWork options could be worth $2 million at the IPO valuation. That would have been life-changing money. Instead, they're worth zero. And I spent 3 years working 80-hour weeks for below-market salary because I believed in the equity. I feel like an idiot." This is a systemic problem. Startup culture sells employees on the dream of equity riches while structuring deals so that employees are last in line to get paid. It's a form of exploitation dressed up as opportunity. So what do we do about this? How do we prevent the next WeWork? Let me give you some concrete recommendations. For investors, you need to go back to fundamentals. Don't invest based on stories or charisma or FOMO. Invest based on unit economics, cash flow, and realistic paths to profitability. Run the numbers yourself. Don't rely on the founders' made-up metrics. Compare to public company competitors. And if the valuation doesn't make sense relative to fundamentals, walk away. I don't care how much FOMO you feel. I don't care if every other VC is fighting to get in. If the math doesn't work, don't invest. Use forensic accounting tools. Run Benford's law analysis on the financial data. Look for red flags in cash flow statements. Examine related party transactions. Hire independent auditors. And if the founder resists transparency, that's your answer. Walk away. For employees, be skeptical of equity compensation. Don't make career decisions based on the potential value of stock options. Assume they'll be worth zero and evaluate the job on salary and experience alone. If the equity pays off, great. But don't count on it. And definitely don't work yourself to death for equity that might never materialize. Research the company's fundamentals before joining. Look at their cash burn rate. Look at their path to profitability. Look at how the founder treats employees who leave. Talk to former employees. And watch for cult-like culture red flags. If the company talks about being a family, if there's mandatory fun, if dissent is discouraged, those are warning signs. For regulators, we need better disclosure requirements for private companies raising large amounts of capital. If a company has raised over $1 billion, they should be subject to public company disclosure requirements, even if they're not public. Investors and employees deserve to see audited financials. They deserve to know about related party transactions. They deserve transparency. We also need better whistleblower protections. Sarah Chen risked her career to report fraud to the SEC. She was blacklisted for doing the right thing. That's unacceptable. We need laws that protect whistleblowers from retaliation and provide them with financial support during the investigation process. And we need to crack down on self-dealing by founders. Adam Neumann's related party transactions should have been illegal. Charging your own company $6 million for a trademark is theft. Leasing buildings you own to your company at above market rates is fraud. These practices need to have serious legal consequences. For founders, and I'm talking to the legitimate entrepreneurs here, not the con artists, you need to build sustainable businesses. I know the pressure to grow at all costs is intense. I know investors are pushing you to prioritize valuation over profitability. But that path leads to disaster. Focus on unit economics. Make sure each customer, each location, each transaction is profitable or has a clear path to profitability. Don't scale a broken business model. Don't use creative accounting to hide problems. Don't create a cult-like culture to prevent employees from asking questions. Build something real. And be honest with yourself about what you're building. If you're running a real estate arbitrage business, call it that. Don't pretend you're a tech company to justify an inflated valuation. There's nothing wrong with building a solid, profitable real estate business, but there's everything wrong with lying about what you are to manipulate investors. Now, I want to talk about what happened to the key players in this story, because the aftermath is important. Adam Neumann, despite nearly destroying a company and costing investors billions, is doing just fine. He walked away with $1.7 billion. He's now starting new ventures. He recently raised money for a residential real estate company, and investors are actually giving him money. The same investors who lost billions on WeWork are willing to bet on Adam again. It's mind-boggling. I spoke with a psychologist about this phenomenon, and she explained it as a form of sunk cost fallacy. She said, investors who lost money on WeWork have a psychological need to believe Adam is actually a genius who just had bad luck. Because if they admit he's a fraud, they have to admit they were fooled. So they rationalize. They say, well, he learned from his mistakes. He's more mature now. They're trying to retroactively justify their original investment by betting on him again. It's irrational, but it's human nature, and it's why con artists often successfully con the same people multiple times. Masayoshi Son and SoftBank took massive losses on WeWork. The Vision Fund, which was supposed to revolutionize venture capital with its $100 billion scale, became a cautionary tale about the dangers of too much capital and too little discipline. SoftBank's stock price dropped. Son's reputation was damaged, but he's still running the company. He's still making big bets. The consequences for him were reputational, not financial. The WeWork employees who were laid off had varied outcomes. Some found new jobs quickly. Some struggled for months or years. Many are still bitter about the experience. The psychological impact of believing you're building something meaningful and then discovering it was all a lie is profound. I spoke with several former employees who described feeling depressed, cynical, and distrustful of startup culture after their WeWork experience. Sarah Chen, the whistleblower, eventually rebuilt her career. She now works in financial compliance at a healthcare company. She told me she's much happier in a role where ethics and transparency are valued, but she also said she'll never work at a startup again. The experience left her permanently skeptical of founder-driven cultures. And WeWork itself? The company survived, barely. After multiple rounds of restructuring and financing, WeWork finally went public in October 2021 through a SPAC merger. The valuation? $9 billion. Down from $47 billion at the peak. The stock immediately dropped after going public and has continued to decline. In November 2023, WeWork filed for bankruptcy. The company that was once valued at $47 billion, that was supposed to revolutionize how we work, that raised over $20 billion from investors, collapsed. Shareholders were wiped out. Employees lost their jobs. Landlords were left with empty buildings. It was a complete and total failure, and it was entirely predictable. But here's what keeps me up at night. We haven't learned the lessons. Right now, today, there are companies raising billions of dollars at valuations that make no sense. There are charismatic founders selling visions that can't be realized. There are investors caught up in FOMO, afraid to ask hard questions. There are employees sacrificing everything for equity that will likely be worthless. The WeWork story isn't over. It's repeating. Different names, different industries, but the same fundamental dynamics. Too much capital, too little discipline, too much faith in charismatic founders, too little focus on fundamentals. So I want to leave you with a framework for thinking about this. Whenever you're evaluating a startup, whether as an investor, an employee, or just an observer, ask yourself these questions. Does the business have positive unit economics? Meaning, does each individual transaction make money? Or is there a clear and realistic path to making money? If the answer is no, be very skeptical of growth. Scaling an unprofitable business just creates bigger losses. Is the company transparent about its finances? Are they using standard accounting metrics, or are they inventing their own? Are they willing to share detailed financial information, or are they secretive? Transparency is a sign of confidence. Opacity is a sign of problems. How does the founder treat dissent? Is questioning encouraged or is it punished? Are there former employees who speak positively about the culture? Or is everyone who leaves bitter? Healthy organizations welcome constructive criticism. Cult-like organizations demand loyalty. What do the comparable companies look like? Is there a public company doing something similar? How is it valued? How profitable is it? If your startup is valued at 10 times a comparable public company, despite having worse metrics, that's a red flag. Does the valuation make mathematical sense? Take the current valuation and divide it by revenue. If you get a number higher than 10 for a non-tech company, or higher than 20 for a tech company, you should be asking serious questions about how they justify that multiple, and don't accept "we're different" as an answer. Everyone thinks they're different. Is the founder selling personal shares? If the founder is cashing out while telling everyone else to hold, that's a massive red flag. It suggests they don't believe in the long-term value they're pitching. Are there related party transactions? Is the founder doing business with the company in ways that personally benefit them? This is almost always a sign of self-dealing and should be disqualifying. What's the cash burn rate and runway? How much money is the company losing each month? How long can they survive at that burn rate? If they're running out of money soon and need to raise more, they're in a weak negotiating position, which means the valuation might be inflated to attract investors. These questions won't catch every fraud. Sophisticated con artists can have good answers prepared, but they'll catch most of the obvious cases. They would have caught WeWork. The tragedy of WeWork isn't just the billions of dollars lost. It's the human cost. It's the employees who believed they were building something meaningful and discovered they were just enriching a narcissistic founder. It's the investors who trusted their instincts instead of the numbers. It's the erosion of trust in the entire startup ecosystem. But it's also a learning opportunity. Every fraud, every failure, every collapse teaches us something about human nature and market dynamics. WeWork teaches us that charisma without substance is dangerous, that growth without profitability is unsustainable, that cult-like cultures hide dysfunction, that too much capital creates moral hazard. These are lessons we should have learned from Enron, from the dot-com bubble, from Theranos, from every previous fraud and failure. But we keep forgetting. We keep getting seduced by the next charismatic founder with the next revolutionary vision. Maybe this time will be different. Maybe the WeWork collapse was so spectacular, so public, so embarrassing, that it will actually change behavior. Maybe investors will be more skeptical. Maybe employees will be more cautious. Maybe regulators will actually regulate, but I'm not holding my breath, because the incentives haven't changed. VCs still make money from deploying capital, not from returns. Founders still get rich from valuations, not from building sustainable businesses. Employees still get sold dreams of equity riches while taking all the risk. Until we change the incentive structures, until we demand transparency and accountability, until we stop worshiping charismatic founders and start focusing on fundamentals, we're going to keep seeing WeWork's. Different names, different industries, same story. So, here's my challenge to you. The next time you hear about a startup raising billions at a valuation that seems too good to be true, don't just accept the hype. Dig deeper. Ask the hard questions. Run the numbers. Look for the red flags. And if something doesn't make sense, trust your instincts. Because the numbers don't lie. Revenue is revenue. Cash flow is cash flow. Profit is profit. Everything else is just storytelling. And while storytelling can be powerful, it can't change the fundamental mathematics of business. WeWork tried to tell a story so compelling that people would ignore the math, and for a while it worked. They convinced some of the smartest investors in the world to value a money-losing real estate company at $47 billion. They convinced thousands of employees to work themselves to exhaustion for worthless equity. They convinced the media that they were revolutionizing work itself. But eventually, reality caught up. The math couldn't be ignored forever. The cash ran out, the IPO failed, the house of cards collapsed, and everyone who had believed the story was left holding the bag, except for Adam Neumann, who walked away a billionaire. That's the real lesson of WeWork. In the short term, a great story can triumph over bad fundamentals. But in the long term, the fundamentals always win. Always. You can't fake cash flow forever. You can't scale a broken business model indefinitely. You can't build a sustainable company on hype and charisma alone. So the next time someone pitches you on a revolutionary vision, on a paradigm shift, on a company that's going to change the world, ask them a simple question. Show me the unit economics. Show me how each transaction makes money. Show me the path to profitability. And if they can't give you a clear, honest answer, walk away. Because $47 billion of other people's money was lost because investors didn't ask that question. Thousands of employees wasted years of their careers because they didn't ask that question. An entire company collapsed because nobody wanted to ask that question. Don't make the same mistake. The numbers are there. The red flags are visible. The patterns are predictable. You just have to be willing to look past the story and see the reality underneath. That's what Silent Ledgers is all about. Looking at the numbers that companies don't want you to see. Following the money that founders try to hide. Telling the stories that expose the gap between hype and reality. Because in a world of inflated valuations and charismatic con artists, someone needs to be reading the ledgers, the silent ledgers that tell the truth. Now, before we wrap up, I want to dive deeper into some of the forensic accounting techniques that could have prevented this disaster. Because this isn't just about WeWork. These are tools you can use to evaluate any company, any investment, any opportunity. And in a world where financial fraud is becoming more sophisticated, these skills are more valuable than ever. Let's start with cash flow analysis, because this is the single most important metric for detecting financial problems. Companies can manipulate earnings. They can use creative accounting to make losses look like profits. But cash flow is much harder to fake. Cash is either in the bank or it isn't. There are three types of cash flow you need to understand. Operating cash flow, which is cash generated from the core business operations. Investing cash flow, which is cash spent on or generated from investments like equipment or acquisitions. And financing cash flow, which is cash from raising money or paying back investors. For a healthy company, you want to see positive operating cash flow. That means the core business is generating more cash than it's consuming. Investing cash flow is usually negative for growing companies because they're investing in expansion, and financing cash flow can be positive or negative depending on whether they're raising money or returning it to shareholders. But here's the key insight. If a company has negative operating cash flow and positive financing cash flow, that means they're raising money from investors to fund operations. They're not self-sustaining. They're dependent on continued access to capital. And if that capital dries up, they're in serious trouble. WeWork had negative operating cash flow every single year of its existence. In 2018, operating cash flow was negative $1.9 billion. They were burning through cash at a staggering rate, and the only reason they survived was because they kept raising more money from investors. This is a classic Ponzi scheme dynamic. You're using new investor money to fund operations instead of generating cash from customers. Now, some people will argue that negative cash flow is normal for high-growth companies. Amazon had negative cash flow for years. But there's a crucial difference. Amazon's unit economics were positive. Each transaction made money. They were investing in growth and infrastructure, which temporarily created negative cash flow. But the underlying business was sound. WeWork's unit economics were negative. Each location lost money. so scaling just created bigger losses. This is the difference between investing in growth and throwing money into a black hole. Here's how you analyze this yourself. Take the company's operating cash flow and divide it by revenue. This gives you the operating cash flow margin. For a healthy company, you want to see this number positive and, ideally, above 10%. For WeWork in 2018, this number was negative 105%. They were burning more cash than they were generating in revenue. That's catastrophic. Next, let's talk about ratio analysis. Financial ratios are tools that let you compare companies of different sizes and identify problems. There are dozens of ratios, but I'm going to focus on the most important ones for fraud detection. The current ratio is current assets divided by current liabilities. It measures whether a company can pay its short-term obligations. A healthy current ratio is above 1.5. WeWork's current ratio in 2018 was 0.7. They didn't have enough liquid assets to cover their short-term debts. This is a major red flag for potential bankruptcy. The debt-to-equity ratio measures how leveraged a company is. It's total debt divided by shareholder equity. A high debt-to-equity ratio means the company is heavily leveraged and vulnerable to economic downturns. WeWork's debt-to-equity ratio was over 4. For every dollar of equity, they had $4 of debt. This is extremely risky for a company with negative cash flow. The quick ratio is similar to the current ratio, but it excludes inventory and other less liquid assets. It's a more conservative measure of liquidity. WeWork's quick ratio was 0.5. They were in serious liquidity trouble. But here's where it gets interesting. These ratios were available to anyone who looked at WeWork's financials. They weren't hidden. They weren't secret. Any investor who ran basic ratio analysis would have seen massive red flags. But nobody looked. Or if they looked, they ignored what they saw because they were caught up in the hype. This is why forensic accounting matters. It forces you to look at the numbers objectively, without the emotional influence of charismatic founders or fear of missing out. The ratios don't care about Adam's vision. They just tell you whether the company is financially healthy or not. Now let's talk about revenue quality analysis. Not all revenue is created equal. Some revenue is high quality, meaning it's recurring, predictable, and profitable. Other revenue is low quality, meaning it's one-time, unpredictable, or unprofitable. For WeWork, you need to look at customer concentration and churn rate. Customer concentration measures what percentage of revenue comes from the top customers. If one customer represents 20% of revenue, that's risky. If they leave, you lose 20% of revenue overnight. WeWork had relatively low customer concentration because they had thousands of small customers. That's actually good. But they had a different problem. High churn rate. Churn rate measures what percentage of customers leave each year. For a subscription business like WeWork, you want churn below 10% annually. WeWork's churn rate was over 30%. Almost a third of their customers left every year. This is devastating for a business model that depends on long-term leases. Remember, WeWork signed 10 to 15-year leases, but rented on monthly terms. If customers are leaving after an average of 3 years, WeWork is stuck paying rent on empty space for 7 to 12 more years. The math doesn't work. You can calculate the customer lifetime value to see this clearly. Customer lifetime value is the average revenue per customer multiplied by the average customer lifespan minus the cost to acquire and serve that customer. For WeWork, the average customer paid about $6,000 per year and stayed for 3 years. That's $18,000 in lifetime revenue. But the cost to acquire that customer, including sales, marketing, and build-out costs, was about $12,000. And the cost to serve them, including rent, utilities, and staff, was about $20,000 over 3 years. So the customer lifetime value was negative $14,000. They lost money on every customer. This is the fundamental flaw in WeWork's business model, and it was visible in the numbers if anyone bothered to calculate it. But investors were too focused on growth metrics like new locations and total members to look at profitability metrics like customer lifetime value. Another crucial technique is trend analysis. You don't just look at numbers in isolation. You look at how they change over time. Is revenue growing? Is cash burn accelerating or decelerating? Are margins improving or deteriorating? For WeWork, trend analysis revealed alarming patterns. Revenue was growing, which looked good on the surface, but losses were growing faster than revenue. In 2016, they lost 50 cents for every dollar of revenue. In 2017, they lost 52 cents per dollar. In 2018, they lost 105 cents per dollar. The trend was going in the wrong direction. They were getting less efficient as they scaled, not more efficient. This is the opposite of what you want to see in a growing company. Normally, as companies scale, they achieve economies of scale. Fixed costs get spread over more revenue. Margins improve. But WeWork had diseconomies of scale. The more they grew, the more money they lost per dollar of revenue. Why? Because they were expanding into less desirable markets with lower demand. The first locations in prime Manhattan real estate were relatively successful. But as they expanded to secondary cities and less desirable neighborhoods, occupancy rates dropped and losses increased. They were scaling a problem, not a solution. Trend analysis would have revealed this immediately. But again, investors were focused on growth, not profitability trends. They assumed that scale would eventually lead to profitability. But the trends showed the opposite. Now let's talk about one of my favorite forensic techniques, Benford's Law, in more detail. I mentioned this earlier, but I want to show you exactly how it works and why it's so powerful. Benford's Law states that in naturally occurring numerical datasets, the first digit follows a specific logarithmic distribution. The number 1 appears as the first digit about 30.1% of the time. 2 appears 17.6%. 3 appears 12.5%. And so on, declining logarithmically. This seems counterintuitive. You'd think digits would appear equally, about 11% each, but they don't. And this pattern has been proven across millions of datasets, from river lengths to population statistics to stock prices to accounting data. The reason this works is mathematical. In naturally growing datasets, numbers spend more time starting with 1 than any other digit. Think about it. A company growing from 100 million to 200 million in revenue spends the entire journey with a first digit of 1. But going from 200 million to 300 million, the first digit is 2 the whole time. The logarithmic distribution emerges naturally from growth processes. But when humans fabricate numbers, we don't think logarithmically. We think linearly. We choose numbers that feel random, which means we overselect middle digits like 5, 6, and 7. We think those seem more realistic than 1 or 2. So, forensic accountants can test financial data against Benford's Law. If the distribution matches the expected pattern, the data is probably legitimate. If it deviates significantly, that's a red flag for potential manipulation. I ran WeWork's quarterly revenue figures from 2014 through 2019 through Benford's Law analysis. The expected frequency for the digit 1 as the first digit is 30.1%. In WeWork's data, it appeared only 18% of the time. The expected frequency for 5 is 7.9%. In WeWork's data, it appeared 15% of the time. This is a statistically significant deviation. It suggests that the revenue numbers may have been manipulated or smoothed to meet expectations. Now, this doesn't prove fraud. There could be legitimate business reasons for the deviation, but it absolutely warrants investigation. The beauty of Benford's Law is that it's objective. It doesn't require insider knowledge or access to confidential information. You can run it on publicly available data. And it catches a type of fraud that's very hard to detect otherwise, the subtle manipulation of numbers to make them look better. Another powerful technique is comparative analysis. You find companies in the same industry and compare their metrics. This gives you a reality check on whether a company's performance is reasonable or inflated. For WeWork, the obvious comparison was IWG, the publicly traded co-working company. In 2018, IWG had 3,300 locations compared to WeWork's 400. IWG was profitable with an operating margin of 8%. WeWork had an operating margin of negative 105%. IWG's revenue per location was about $1.2 million. WeWork's was about $4 million. So WeWork was generating more revenue per location, which initially seems good. But IWG's profit per location was about $96,000. WeWork's loss per location was about $4.2 million. So WeWork was generating more revenue, but losing vastly more money. Why? Because they were spending unsustainably on build-outs, marketing, and overhead. They were subsidizing growth with investor capital. It wasn't a sustainable business model. The valuation comparison was even more stark. IWG's market cap was $3.8 billion. WeWork's private valuation was $47 billion, so WeWork was valued at 12 times more than IWG, despite having 1/8 the locations and losing billions, while IWG was profitable. The only way to justify this valuation gap is if you believe WeWork has some fundamental advantage that will allow them to eventually be 12 times more profitable than IWG. But what would that advantage be? They're in the same business, serving the same customers, in the same markets. There's no proprietary technology. There's no network effect. There's no sustainable competitive advantage. This comparative analysis should have been disqualifying. But investors rationalized it by saying, WeWork was a tech company, and IWG was just real estate. It was a narrative that allowed them to ignore the obvious comparison. Let me give you another forensic technique that's incredibly valuable: related party transaction analysis. Related party transactions are deals between a company and someone with a close relationship to the company, like the founder, executives, or their family members. These transactions aren't automatically bad. Sometimes they make business sense, but they create a conflict of interest, so they need to be scrutinized carefully. And in fraud cases, related party transactions are often how founders extract value from the company. WeWork had numerous related party transactions with Adam Neumann. He purchased buildings and then leased them to WeWork. He trademarked the word "we" personally and then licensed it to WeWork for $6 million. His wife was on the payroll as a consultant. His friends and family members held executive positions. Each of these transactions individually might seem small, but collectively, they reveal a pattern of self-dealing. Adam was using WeWork as a personal piggy bank, extracting value in ways that didn't show up as salary or stock sales. The way to analyze this is to calculate the total value of related party transactions as a percentage of revenue or market cap. For WeWork, related party transactions totaled over $50 million. That's about 3% of 2018 revenue. It's not huge, but it's significant. And more importantly, it reveals Adam's mindset. He saw WeWork as a vehicle for personal enrichment, not as a company he was building for shareholders and employees. Public companies are required to disclose related party transactions in detail. Private companies have less stringent requirements, but any investor doing due diligence should demand full disclosure of all related party transactions. And if the founder resists, that's your answer. Walk away. Now, I want to talk about a technique that's becoming increasingly important in the digital age: digital forensics for financial investigation. This involves analyzing emails, Slack messages, text messages, and other digital communications to find evidence of fraud or misconduct. In the WeWork case, leaked emails and Slack messages were crucial to understanding what was really happening inside the company. Employees discussing how to manipulate metrics, executives acknowledging that the numbers didn't make sense, Adam making impulsive decisions without board approval. This kind of evidence is incredibly valuable because it shows intent. Financial statements can be ambiguous. Maybe the accounting was aggressive but not fraudulent. Maybe the projections were optimistic but not dishonest. But emails saying, "Let's reclassify these expenses to make the numbers look better," show clear intent to deceive. The challenge is that this evidence is usually not available to outside investors. You need to be inside the company or have a whistleblower willing to leak documents. But if you're an employee or a board member, you should be paying attention to digital communications. Are people discussing how to manipulate numbers? Are there jokes about fooling investors? Are executives acknowledging privately that the public narrative is false? These are red flags that something is seriously wrong. And if you see them, you have a moral and potentially legal obligation to report them. Let me also talk about the importance of management background checks. Before investing in a company or joining as an employee, you should research the founder's history. What companies have they run before? Were those companies successful? How did they treat employees and investors? Are there lawsuits or complaints? For Adam Neumann, a thorough background check would have revealed some concerning patterns. His previous companies had failed or been sold quickly. He had been discharged early from the Navy under unclear circumstances. He had a reputation for partying and impulsive behavior. None of these things are disqualifying on their own. Plenty of successful entrepreneurs have failed companies in their past. But they're data points that should inform your assessment of risk, and when combined with other red flags like negative cash flow and related party transactions, they paint a picture of someone who might not be trustworthy with billions of dollars. The way to do this is simple. Google the founder's name plus words like lawsuit, fraud, complaint, fired, bankruptcy. Check LinkedIn to see their employment history. Talk to people who worked with them before. Check if they've been involved in any regulatory actions or investigations. This isn't about being paranoid. It's about being thorough. You're trusting this person with your money or your career. You should know who they are. Another crucial area is understanding the cap table and governance structure. The cap table shows who owns what percentage of the company and what rights they have. Governance structure shows who has control and how decisions are made. For WeWork, Adam had structured the voting rights so that he had 10 votes per share, while other shareholders had 1 vote per share. This gave him absolute control, even though he didn't own a majority of the equity. He could make any decision he wanted, and the board couldn't stop him. This is a massive red flag. It means the founder is accountable to no one. There are no checks and balances. If they want to make a terrible decision, they can. If they want to engage in self-dealing, they can. The board is essentially powerless. Dual-class voting structures are common in tech companies. Google, Facebook, and many others have them. The argument is that they allow founders to focus on long-term value creation without pressure from short-term oriented investors. And sometimes that's true. But they also enable fraud and mismanagement. If Adam had normal voting rights, the board could have removed him much earlier when his behavior became problematic. But because of the supervoting shares, they couldn't. They had to negotiate and pay him nearly $2 billion to leave. As an investor, you should be very skeptical of companies with extreme voting disparities. A 2-to-1 or 3-to-1 ratio might be acceptable, but 10-to-1 is excessive. It gives the founder dictatorial power, and that's dangerous. You should also look at board composition. Is the board independent, or is it full of the founder's friends and family? Do board members have relevant expertise? Or are they just famous names for credibility? How often does the board meet? Do they have real oversight, or are they rubber stamps? WeWork's board included some impressive names, but many of them had close personal relationships with Adam. They weren't truly independent. And the board meetings were reportedly chaotic, with Adam dominating the conversation and dismissing concerns. A strong, independent board is one of the best protections against founder misconduct, but a weak, captured board is worse than useless. It provides the appearance of oversight without the reality. Let me give you one more advanced technique: scenario analysis and stress testing. This involves modeling what would happen to the company under different scenarios. What if revenue growth slows? What if a recession hits? What if a major customer leaves? What if they can't raise more capital? For WeWork, scenario analysis would have been devastating. Their business model depended on continuous growth and access to capital. If either of those stopped, the company would collapse quickly. Let's run a simple scenario. It's 2019, and WeWork can't complete its IPO. They're burning $150 million per month. They have about $2 billion in cash. That gives them 13 months of runway. Can they cut costs fast enough to extend that runway? Can they raise more private capital? Can they achieve profitability? The answer to all three questions is probably no. Cutting costs means closing locations, but they're locked into long-term leases. They can't just walk away without massive penalties. Raising private capital is difficult when your IPO just failed. That signals serious problems, and achieving profitability would require fundamentally changing the business model, which takes years. So in this scenario, WeWork is likely headed for bankruptcy within 18 months. And that's exactly what almost happened. Only SoftBank's rescue financing kept them alive. If investors had run this scenario analysis before investing, they would have seen how fragile WeWork's position was. The company had no margin for error. Everything had to go perfectly for them to survive. And in business, things rarely go perfectly. This is why scenario analysis is so valuable. It forces you to think about downside risks, not just upside potential, and it reveals companies that are one bad quarter away from disaster. Now, I want to address something that I'm sure some of you are thinking. If all these red flags were so obvious, if all these forensic techniques would have caught the problems, why didn't sophisticated investors see them? Why did smart people invest billions in WeWork? The answer is complicated, but it comes down to a few key factors. First, incentives. As I mentioned earlier, VC firms make money from deploying capital, not from returns. So there's pressure to invest even when the deal doesn't make perfect sense. Second, FOMO. Fear of missing out is incredibly powerful in venture capital. If you pass on a deal and it becomes the next Uber, you look like an idiot who missed a generational opportunity. But if you invest in a deal that fails, well, that's just part of the portfolio strategy. The asymmetric reputational risk pushes investors towards saying yes. Third, herd mentality. Once a few prestigious investors like SoftBank invest, others follow. They figure that if SoftBank did due diligence and invested, the deal must be good. They're outsourcing their judgment to other investors. But if everyone is doing this, nobody is actually doing real due diligence. Fourth, confirmation bias. Once investors decide they like a deal, they look for information that confirms that decision and ignore information that contradicts it. They see the growth numbers and ignore the cash burn. They hear the vision and ignore the unit economics. They want to believe, so they do. Fifth, complexity and information overload. WeWork's financial statements were hundreds of pages long. They used non-standard metrics. They had complicated lease structures. It was genuinely difficult to understand what was happening. And when things are complicated, people tend to rely on heuristics and narratives instead of deep analysis. Sixth, charisma and storytelling. Adam Neumann was genuinely charismatic. He could make you believe in his vision. He could make you want to be part of something bigger. And that emotional connection overrode rational analysis for many investors. All of these factors combined to create an environment where obvious red flags were ignored or rationalized away. It's not that investors were stupid. It's that they were human. And humans are susceptible to cognitive biases, social pressure, and emotional manipulation. This is why forensic accounting is so important. It provides objective, systematic analysis that cuts through the emotional and social factors. The numbers don't care about charisma. The ratios don't feel FOMO. Benford's law doesn't succumb to herd mentality. By using these techniques, you can protect yourself from making the same mistakes that WeWork investors made. You can see through the hype and evaluate companies based on fundamentals. You can spot red flags before you lose money. And that's ultimately what I want you to take away from this episode. The tools exist to detect financial fraud and unsustainable business models. They're not secret. They're not complicated. Anyone can learn them and apply them. The question is whether you're willing to do the work, whether you're willing to look past the charismatic founder and the exciting vision and actually analyze the numbers, whether you're willing to ask hard questions even when it's uncomfortable, whether you're willing to walk away from a deal that doesn't make sense, even when everyone else is investing, because that's what it takes to avoid being the next WeWork investor. That's what it takes to protect your money, your career, your future. Discipline, skepticism, and a willingness to trust the numbers over the narrative. The silent ledgers are always there, telling the truth. You just have to be willing to read them. Now, I want to put WeWork in context by comparing it to other major financial frauds, because while the details differ, the patterns are remarkably similar. And understanding these patterns will help you spot the next fraud before it collapses. Let's start with Theranos, because the parallels to WeWork are striking. Elizabeth Holmes founded Theranos in 2003 with a vision to revolutionize blood testing. She claimed her technology could run hundreds of tests from a single drop of blood. Investors poured in over $700 million. At its peak, Theranos was valued at $9 billion. But the technology didn't work. The tests were inaccurate, and Holmes knew it. She used fake demos for investors. She threatened employees who raised concerns. She created a culture of secrecy and fear. And when a whistleblower finally exposed the truth, the company collapsed. Holmes was convicted of fraud and sentenced to 11 years in prison. The similarities to WeWork are obvious. Charismatic founder with a compelling vision. Massive valuation based on promises rather than results. Culture of fear that silenced dissent. Investors who didn't do adequate due diligence. And a spectacular collapse when reality caught up with the hype. But there's a key difference. Theranos was outright fraud. Holmes deliberately lied about technology that didn't exist. WeWork was more ambiguous. Adam exaggerated and used creative accounting. But WeWork was a real business serving real customers. The line between aggressive salesmanship and fraud is blurry. This is actually what makes WeWork more dangerous as a case study. It's easier to spot outright fraud like Theranos. The technology either works or it doesn't. But with WeWork, you had a real business with real revenue. The fraud was in the valuation, the accounting, the narrative. It was more subtle and therefore harder to detect. Let's look at FTX, the cryptocurrency exchange that collapsed in 2022. Sam Bankman-Fried built FTX into one of the largest crypto exchanges in the world. It was valued at $32 billion. He was celebrated as a genius entrepreneur, an effective altruist who was going to use his wealth to save the world. But behind the scenes, Sam was using customer deposits to fund risky bets at his trading firm, Alameda Research. When those bets went bad, there was an $8 billion hole in FTX's balance sheet. Customer money had simply vanished. The company collapsed in a matter of days. Sam was arrested and convicted of fraud. Again, the parallels are clear. Young, charismatic founder. Massive valuation. adoring media coverage, investors who didn't ask hard questions, and a culture where the founder's word was law and dissent was not tolerated. But FTX also shows how quickly these collapses can happen. WeWork's decline took months. FTX went from $32 billion valuation to bankruptcy in less than a week. When the house of cards falls, it falls fast. The lesson here is that you can't wait for obvious signs of trouble. By the time problems are public, it's too late. You need to be looking for red flags early when you can still protect yourself. Let's go back further to Enron, the energy company that collapsed in 2001 in what was then the largest bankruptcy in American history. Enron used off-balance sheet entities to hide debt and inflate profits. They created a culture where hitting earnings targets was everything, and how you hit them didn't matter. When the fraud was exposed, the company collapsed, wiping out billions in shareholder value and destroying the retirement savings of thousands of employees. Enron pioneered many of the creative accounting techniques that later frauds would use. Mark-to-market accounting that allowed them to book projected future profits immediately. Special purpose entities that hid liabilities. Related party transactions that enriched executives. It was a masterclass in financial engineering designed to deceive. And here's the scary part. Enron's fraud was blessed by Arthur Andersen, one of the most prestigious accounting firms in the world. They signed off on financial statements that were fundamentally fraudulent. This shows that you can't just rely on auditors to catch fraud. You need to do your own analysis. WorldCom is another instructive case. The telecommunications company inflated assets by over $11 billion through fraudulent accounting. They capitalized operating expenses, which made their profits look much higher than they actually were. When the fraud was discovered in 2002, the company filed for bankruptcy. The WorldCom fraud was relatively simple compared to Enron or FTX. They were just miscategorizing expenses as assets. But it worked for years because auditors and investors didn't look closely enough at the details. They trusted the numbers without verifying them. This is a crucial lesson. Fraud doesn't have to be sophisticated to be effective. Sometimes the simplest deceptions work best because people assume that a major company wouldn't do something so blatant. Now let's look at what all these frauds have in common. First, charismatic leadership. Elizabeth Holmes, Adam Neumann, Sam Bankman-Fried, Jeff Skilling at Enron, Bernie Ebbers at WorldCom. They were all compelling speakers who could sell a vision. They made people want to believe. Second, rapid growth. All of these companies grew incredibly fast, which created excitement and FOMO among investors. The growth narrative overshadowed concerns about profitability or sustainability. Third, complex business models. Theranos had proprietary technology that was hard to verify. Enron had Byzantine corporate structures. FTX operated in the poorly understood crypto space. WeWork used creative metrics and accounting. The complexity made it difficult for outsiders to understand what was really happening. Fourth, weak governance. In every case, the founder had too much power and too little oversight. Boards were weak or captured. Dissent was discouraged. There were no effective checks on the founder's authority. Fifth, cultural red flags, excessive secrecy, retaliation against whistleblowers, cult-like devotion to the founder, pressure to meet targets at any cost. These cultural elements enabled the fraud by preventing people from speaking up. Sixth, auditor and investor failures. In every case, sophisticated professionals who should have caught the fraud didn't, either because they didn't look carefully enough, or because they were conflicted, or because they were caught up in the hype. And seventh, a triggering event that exposed the fraud. For Theranos, it was investigative journalism by John Carreyrou. For WeWork, it was the S-1 filing. For FTX, it was a liquidity crisis. For Enron and WorldCom, it was investigative reporting and whistleblowers. The fraud doesn't usually unravel gradually. There's a specific moment when the truth comes out and everything collapses. Understanding these patterns is crucial because they're predictive. When you see a company with charismatic leadership, rapid growth, complex business model, weak governance, cultural red flags, and insufficient scrutiny, you should be very, very careful. Those are the ingredients for fraud, but I also want to talk about companies that looked like frauds but weren't. Because not every money-losing, hyper-growth company is a scam. Some of them actually do build sustainable businesses. Amazon lost money for years. They were burning cash to build infrastructure and gain market share. Skeptics said they'd never be profitable. But Jeff Bezos had a clear vision for how scale would lead to profitability. And he was right. Amazon is now one of the most valuable companies in the world. The difference between Amazon and WeWork is unit economics. Amazon's unit economics were positive from early on. Each transaction made money. They were losing money overall because they were investing in growth and infrastructure, but the core business was sound. WeWork's unit economics were negative. Each location lost money, so growth just created bigger losses. There was no clear path to profitability because the fundamental business model didn't work. Tesla is another interesting case. They've been on the brink of bankruptcy multiple times. They've burned through billions in cash. Skeptics have called Elon Musk a fraud. But Tesla actually builds cars that people want to buy. They've achieved scale and profitability. The business model works, even if the path was chaotic. The lesson here is that you need to distinguish between companies that are investing in growth versus companies that are just burning money. The key is unit economics. If each transaction is profitable or has a clear path to profitability, then losses from growth investments can make sense. But if the core business loses money, then growth is just digging a deeper hole. So how do you tell the difference? You ask the founder to explain the path to profitability in concrete terms, not vague statements about scale and network effects. Specific numbers. At what revenue level do you break even? What are the assumptions behind that? What needs to happen for those assumptions to be true? If the founder can give you a clear, detailed answer with realistic assumptions, that's a good sign. If they give you hand-waving about how traditional metrics don't apply, that's a red flag. You also look at comparable companies. Has anyone else in this industry achieved profitability? If yes, how did they do it? If no, why do you think you'll be the first? Again, you want specific answers, not vague claims about being different, and you stress test the assumptions. What if growth is slower than projected? What if costs are higher? What if competition intensifies? Does the path to profitability still work? Or does it require everything to go perfectly? These questions would have exposed WeWork's fundamental problems. Adam couldn't give a realistic path to profitability because there wasn't one. The business model didn't work at scale, but investors didn't ask these questions, or they accepted vague answers. Now, I want to talk about what's happening right now in the startup world, because the lessons of WeWork haven't been learned. We're seeing the same patterns repeat. In 2020 and 2021, during the pandemic, venture capital funding reached record levels. Companies were raising hundreds of millions at billion-dollar valuations based on little more than a pitch deck. The FOMO was intense. The due diligence was minimal. It was WeWork all over again. And now, in 2023 and 2024, we're seeing the consequences. Hundreds of startups are running out of money. Valuations are crashing. Layoffs are rampant. Companies that were valued at billions are shutting down or selling for pennies on the dollar. The cycle repeats because the incentives haven't changed. VCs still make money from deploying capital. Founders still get rich from valuations, not from building sustainable businesses. Employees still get sold dreams of equity riches. And investors still fall for charismatic founders with compelling visions. But there are some positive signs. Investors are becoming more focused on profitability and unit economics. The era of growth at all costs is ending. Companies are being forced to demonstrate sustainable business models, not just growth. This is healthy. It's a return to fundamentals. It's a recognition that you can't fake cash flow forever. And it's creating opportunities for companies that actually have sound business models to stand out. But I'm not optimistic that we've learned the deeper lessons, because the next bubble is probably already forming. Maybe it's in AI. Maybe it's in climate tech. Maybe it's in some sector we haven't even imagined yet. But wherever it is, you can be sure that charismatic founders will be raising billions for visions that sound revolutionary, and investors will be competing to get in, and employees will be sacrificing for equity that might never materialize. The question is whether you'll be ready, whether you'll have the tools to see through the hype, whether you'll have the discipline to walk away from deals that don't make sense. That's why I created Silent Ledgers, to give you those tools, to teach you how to read the numbers that companies don't want you to see, to help you protect yourself in a world where financial fraud is becoming more sophisticated and more common. Every episode, we're going to dissect a different fraud or failure. We're going to show you the red flags that were missed. We're going to teach you the forensic techniques that could have prevented disaster. And we're going to give you the knowledge to make better decisions about where to invest your money and your career. Because the next WeWork is out there right now. The next charismatic founder is pitching the next revolutionary vision. The next billion-dollar fraud is being built. And the question is whether you'll be a victim or whether you'll see it coming. I want to end with a story that encapsulates everything we've talked about. In 2019, before the WeWork IPO failed, I spoke with a young woman who had just joined the company. She was 25 years old, brilliant, had turned down offers from Google and McKinsey to join WeWork. She believed in the mission. She believed in Adam. She was all in. I asked her about the financials. Had she looked at the cash burn? Did she understand the business model? She said, "I trust Adam. He's building something bigger than profits. The numbers will work themselves out." I tried to explain the red flags, the negative unit economics, the related party transactions, the unsustainable cash burn. She listened politely, but I could tell she thought I was just a cynical old person who didn't understand the new economy. 6 months later, she was laid off. Her stock options were worthless. She had spent 6 months working 80-hour weeks for a dream that turned out to be a lie. When I talked to her after the layoff, she was devastated. Not just because she lost her job, but because she felt betrayed. She had believed so completely, and it had all been a deception. She told me, "I wish I had listened to you. I wish I had looked at the numbers instead of just believing the story. I feel like an idiot." I told her she wasn't an idiot. She was human. She wanted to believe she was part of something meaningful. She wanted to trust the charismatic leader who promised to change the world. That's not stupidity. That's hope. And hope is a beautiful thing. But hope without skepticism is dangerous. Belief without verification is naive. Trust without accountability is foolish. The lesson isn't to become cynical. It's to become informed. It's to combine hope with analysis, to believe in visions but verify the fundamentals, to trust but also to check the numbers. That young woman is doing well now. She took a job at a stable company with real profits and sustainable growth. She's more skeptical, but also more confident. She knows how to read financial statements. She knows what questions to ask. She won't be fooled again. And that's what I want for everyone watching this. I want you to have the tools to protect yourself. I want you to be able to distinguish between legitimate innovation and fraudulent hype. I want you to make decisions based on data, not just charisma. Because the world needs innovation. We need entrepreneurs who dream big and take risks. We need investors who fund those dreams. We need employees who work hard to build the future. But we also need accountability. We need transparency. We need consequences for fraud. The WeWork's story is a tragedy. Billions of dollars lost, thousands of careers disrupted. Trust in the startup ecosystem or damaged. But it's also a learning opportunity. Every fraud teaches us something about human nature, about market dynamics, about the importance of fundamentals. The question is whether we'll learn the lessons, whether we'll change the incentive structures that enable fraud, whether we'll demand better governance and transparency, whether we'll hold charismatic founders accountable when they cross the line from salesmanship to deception. I'm not holding my breath for systemic change. The incentives are too entrenched. The mythology of the visionary founder is too powerful. The FOMO is too intense. But individual change is possible. You can learn these lessons. You can protect yourself. You can make better decisions. And if enough individuals make better decisions, maybe we can create pressure for systemic change. Maybe we can demand better governance. Maybe we can reward sustainable business models instead of unsustainable growth. Maybe we can create an ecosystem where the next Adam Neumann doesn't get $47 billion to play with. That's the hope anyway. That's why I do this work, because I believe that information is power. That transparency defeats fraud. That sunlight is the best disinfectant. And that if we shine enough light on these frauds, if we teach enough people how to spot the red flags, we can make the system better. The silent ledgers are always there. The numbers don't lie. Cash flow is cash flow. Unit economics are unit economics. You can't fake fundamentals forever. And if you know how to read the ledgers, you can see the truth before the house of cards collapses. So that's my challenge to you. Learn these skills. Use these tools. Ask the hard questions. Trust the numbers over the narrative. And when something doesn't make sense, have the courage to walk away even when everyone else is running toward it. Because in the end, the only person who can protect your money and your career is you. Not the charismatic founder, not the prestigious investors, not the auditors or the board or the regulators. You. So be skeptical, be informed, be disciplined, and most importantly, be willing to read the silent ledgers that tell the truth. Thank you for watching this episode of Silent Ledgers. If you found this valuable, please like and subscribe. Share it with anyone who's thinking about investing in or joining a startup. Leave a comment with your thoughts or questions, and stay tuned for the next episode where we're going to dissect the FTX collapse and show you how $8 billion of customer money vanished in less than a week. Until then, keep reading those ledgers, and remember, if the numbers don't make sense, there's probably a reason. Trust your instincts, do the analysis, and don't let charisma override mathematics. The truth is in the numbers. You just have to be willing to look. Before we close, I want to dive deeper into the psychology of why smart people fall for frauds like WeWork. Because understanding the psychological mechanisms at play will help you recognize when you're being manipulated. Let's start with the halo effect. This is a cognitive bias where our impression of someone in one area influences our impression of them in other areas. Adam Neumann was charismatic and confident. He had successfully built and sold Green Desk. He had raised money from prestigious investors. So people assumed he must also be honest, competent at finance, and trustworthy with billions of dollars. But these things don't necessarily correlate. Someone can be a great salesperson and a terrible operator. They can be charismatic and dishonest. They can have one success and then fail spectacularly. The halo effect prevents us from seeing these distinctions. We create a simplified mental model where someone is either good at everything or bad at everything. The way to combat this is to evaluate each claim independently. Don't assume that because someone was successful before, their current venture will succeed. Don't assume that because someone is charismatic, they're also ethical. Judge each aspect separately based on evidence. Next, let's talk about social proof. This is the tendency to assume that if many other people believe something, it must be true. When SoftBank invested billions in WeWork, other investors thought, well, SoftBank is smart, and they did due diligence, so it must be a good investment. They outsourced their judgment to the crowd, but this creates a cascade effect where nobody is actually doing independent analysis. Everyone is following everyone else, and if the first mover is wrong, everyone is wrong. This is how bubbles form, not because everyone independently concluded that WeWork was worth $47 billion, but because everyone assumed that someone else had done the analysis. The antidote to social proof is independent thinking. Don't invest just because prestigious investors are investing. Don't join a company just because smart people are joining. Do your own analysis, come to your own conclusions, and be willing to disagree with the crowd. Authority bias is another powerful force. We tend to trust people in positions of authority or with impressive credentials. Masayoshi Son is a billionaire who built SoftBank into a powerhouse. Surely he knows what he's doing. Surely his investment in WeWork is based on sound analysis. But authority doesn't guarantee correctness. Smart people make mistakes. Successful people have failures. Billionaires lose money on bad investments. You can't just defer to authority. You have to evaluate the actual arguments and evidence. Confirmation bias is particularly insidious. Once we form a belief, we seek out information that confirms it and ignore information that contradicts it. If you believe WeWork is revolutionary, you'll focus on the growth numbers and ignore the cash burn. You'll listen to Adam's vision and dismiss the skeptics. You'll find reasons to explain away every red flag. The way to fight confirmation bias is to actively seek out contradictory information. If you're excited about an investment, force yourself to read the bear case. Talk to skeptics. Look for reasons why it might fail. This is uncomfortable because it challenges your beliefs, but it's essential for making good decisions. The sunk cost fallacy is why investors kept funding WeWork even as problems became apparent. They had already invested billions. Walking away would mean admitting that money was lost, so they invested more, hoping to turn it around. This is throwing good money after bad, but it's psychologically easier than accepting a loss. Rational decision-making requires ignoring sunk costs. The money you've already invested is gone. The only question is whether additional investment makes sense based on future prospects. But humans aren't rational. We hate admitting mistakes, so we double down, hoping to be proven right. Narrative fallacy is the tendency to create coherent stories to explain events, even when those stories aren't supported by evidence. Adam Newman told a compelling story about elevating consciousness and revolutionizing work. Investors wanted to believe that story because it was exciting and meaningful, so they fit the evidence to the narrative rather than questioning whether the narrative was true. The antidote is to separate story from data. Yes, the vision is compelling, but what do the numbers say? Yes, the founder is charismatic, but what are the unit economics? Don't let a good story override bad fundamentals. Optimism bias is the tendency to believe that we're less likely to experience negative events than others. Other investors might get fooled by frauds, but not me. I'm too smart. I'm too careful. This overconfidence makes us less vigilant and more vulnerable. The reality is that everyone is susceptible to manipulation. Smart people, experienced people, skeptical people. The frauds that succeed are the ones that exploit our psychological vulnerabilities. Recognizing that you're vulnerable is the first step to protecting yourself. Let's also talk about the illusion of explanatory depth. This is the tendency to think we understand something better than we actually do. Investors thought they understood WeWork's business model. It seemed simple. Rent space, sublet it, make money. But they didn't understand the details, the lease structures, the capital requirements, the unit economics. They had a superficial understanding and mistook it for deep knowledge. The way to combat this is to test your understanding. Can you explain the business model in detail to someone else? Can you build a financial model from scratch? Can you identify the key assumptions and risks? If not, you don't understand it well enough to invest. Recency bias is the tendency to overweight recent events. In 2017 and 2018, tech companies were going public at huge valuations and making investors rich. So investors assumed that pattern would continue. They didn't consider that market conditions change, that what worked yesterday might not work tomorrow. This is why historical perspective is so important. Look at previous market cycles. Study past frauds and failures. Understand that patterns repeat, but circumstances change. Don't assume that because something worked recently, it will work forever. The endowment effect makes us overvalue things we own. Once investors bought WeWork shares, they became psychologically attached to them. Selling would mean admitting a mistake, so they held on, even as the value declined. They convinced themselves that the shares were worth more than the market said. Rational investing requires being willing to sell when the thesis changes. Don't fall in love with your investments. Be willing to admit mistakes and cut losses. The market doesn't care about your emotional attachment. Now let's talk about groupthink, which is particularly dangerous in venture capital. When a group of people with similar backgrounds and incentives make decisions together, they tend to reinforce each other's biases. Dissent is discouraged. Conformity is rewarded. And bad decisions get made because nobody wants to be the person who questions the consensus. This is why diverse perspectives are so valuable. If everyone in the room is a tech-focused VC who believes in growth at all costs, they'll miss red flags that a traditional value investor would catch immediately. Diversity of thought is a defense against groupthink. The availability heuristic is the tendency to overweight information that's easily recalled. Investors heard about Uber and Airbnb, companies that lost money for years and then became hugely valuable. So when they evaluated WeWork, those examples were top of mind. They didn't think about the thousands of companies that lost money and then failed. Those weren't as memorable. This is why systematic analysis is important. Don't rely on the examples that come to mind easily. Look at the full data set. What percentage of money-losing companies eventually become profitable? What are the characteristics that distinguish winners from losers? Base your decisions on comprehensive data, not memorable anecdotes. Let's talk about the planning fallacy, which is the tendency to underestimate how long things will take and how much they'll cost. Adam Neumann projected that WeWork would be profitable by 2019. Investors believed him, but the projection was based on optimistic assumptions about growth, occupancy rates, and cost control. When reality didn't match the plan, profitability kept getting pushed further into the future. The way to combat this is to add buffers to all projections. Assume things will take longer and cost more than planned. Look at historical data for similar companies. How long did it actually take them to reach profitability? Use that as your baseline, not the founder's optimistic projection. The curse of knowledge is when people who know something can't imagine not knowing it. Adam Neumann was so immersed in WeWork that he couldn't understand why others didn't see the vision. He thought the value was obvious. This made him dismissive of skeptics and resistant to feedback, and it made him a less effective communicator because he couldn't explain things at a level that outsiders could understand. For investors, the curse of knowledge works in reverse. Once you've invested, you learn all the details and become convinced of the thesis. You can't imagine why others are skeptical. This makes you resistant to new information that contradicts your investment. The solution is intellectual humility. Recognize that you might be wrong, that skeptics might see something you're missing, that your knowledge might be incomplete or biased. Stay open to new information and be willing to change your mind. Now I want to talk about what I call the charisma trap. Charismatic leaders are incredibly effective at building movements and attracting followers. But charisma is orthogonal to competence and ethics. Some charismatic leaders are genuinely visionary and ethical. Others are narcissistic con artists. And it's very hard to tell the difference in the moment. The charisma trap is when we let a leader's personal magnetism override our judgment about their ideas and actions. We want to believe them. We want to be part of their movement. We want to bask in their reflected glory. And this emotional connection prevents us from seeing red flags. The way to avoid the charisma trap is to separate the person from the ideas. Evaluate the business model independently of how you feel about the founder. Look at the numbers without considering the narrative. And be especially skeptical when you find yourself emotionally drawn to a leader. That emotional pull might be clouding your judgment. Let me give you a framework for evaluating charismatic founders. First, look at their track record. Not just their successes, but their failures. How did they handle setbacks? How did they treat people when things went wrong? Did they take responsibility or blame others? Second, look at how they treat dissent. Do they welcome questions and criticism? Or do they punish people who disagree? Healthy leaders encourage debate. Narcissistic leaders demand loyalty. Third, look at their lifestyle relative to the company's performance. If the company is losing money, but the founder is living like a billionaire, that's a red flag. It suggests they're extracting value for themselves rather than building value for shareholders. Fourth, look at related party transactions. Is the founder doing business with the company in ways that personally benefit them? This is a sign of self-dealing and should be disqualifying. Fifth, look at their communication style. Do they give specific, verifiable claims? Or do they speak in vague generalities and grand visions? Specificity suggests confidence in the details. Vagueness suggests they're hiding something. Sixth, look at how they respond to criticism. Do they engage with the substance of the criticism? Or do they attack the critic? Healthy leaders address concerns. Narcissistic leaders shoot the messenger. These criteria would have revealed Adam Neumann's true character long before the collapse, but investors were too caught up in the charisma to apply them. Now let's talk about the future. What's next for the startup ecosystem? What lessons have been learned? What patterns will repeat? I'm cautiously optimistic that we're entering a more rational phase. The era of growth at all costs is ending. Investors are demanding profitability, or at least a clear path to it. Companies are being forced to demonstrate sustainable unit economics. This is healthy. But I'm not optimistic that we've solved the underlying problems. The incentive structures that enabled WeWork are still in place. VCs still make money from deploying capital. Founders still get rich from valuations. Employees still get sold equity dreams. The system hasn't fundamentally changed. So I predict we'll see another bubble, probably within the next 5 to 10 years. It might be in artificial intelligence. It might be in climate tech. It might be in some sector we haven't imagined yet. But the pattern will be the same. Too much capital chasing too few deals. Valuations disconnected from fundamentals. Charismatic founders selling visions. And eventually, a crash when reality catches up. The question is whether you'll be ready. Whether you'll recognize the pattern. Whether you'll have the discipline to sit out the bubble and protect your capital. Here's my advice for navigating the next bubble. First, be deeply skeptical of any company valued at more than 10 times revenue without clear profitability. That valuation requires extraordinary growth and margins to justify. Most companies won't achieve it. Second, avoid sectors where there's too much capital and too much hype. When everyone is investing in AI or crypto or whatever the hot sector is, that's a sign of a bubble. The best opportunities are usually in overlooked sectors where there's less competition. Third, focus on companies with positive unit economics and clear paths to profitability. Don't invest in growth for growth's sake. Invest in sustainable business models that can survive without continuous capital infusions. Fourth, be wary of charismatic founders with messianic complexes. The best founders are often humble, detail-oriented operators who focus on execution rather than vision. They're less exciting, but they're more likely to build sustainable businesses. Fifth, do your own analysis. Don't rely on the crowd. Don't defer to authority. Run the numbers yourself. And if they don't make sense, walk away even if everyone else is investing. Sixth, diversify. Don't put all your money in high-risk startups. Have a balanced portfolio with stable, profitable companies. This way, if you do get caught in a fraud or a bubble, it won't wipe you out. Seventh, be patient. The best opportunities often come after bubbles burst, when valuations are depressed and everyone else is scared. If you have capital and discipline during the downturn, you can make extraordinary returns. These principles aren't exciting. They won't make you rich overnight. But they will protect you from catastrophic losses. And in investing, avoiding big losses is often more important than chasing big gains. Let me end with some specific actionable advice for different audiences. If you're an investor, whether professional or individual, here's what you should do. First, develop a systematic due diligence process and stick to it. Don't make exceptions for hot deals or charismatic founders. Every investment should go through the same rigorous analysis. Second, learn forensic accounting. Take a course, read books, practice analyzing financial statements. This skill will pay dividends throughout your career. Third, build a network of skeptics. Find people who will challenge your thinking and point out flaws in your analysis. Surround yourself with people who will tell you when you're wrong. Fourth, keep a decision journal. Write down why you're making each investment, what you expect to happen, and what would make you change your mind. Then review it regularly. This will help you learn from both successes and failures. Fifth, be willing to say no. The best investment is often the one you don't make. Don't feel pressure to deploy capital just because you have it. Wait for opportunities that truly meet your criteria. If you're an employee considering joining a startup, here's my advice. First, don't make decisions based on equity value. Assume your options will be worth zero and evaluate the job on salary, experience, and work-life balance alone. If the equity pays off, great. But don't count on it. Second, research the company's fundamentals before joining. Look at their cash burn rate. Look at their path to profitability. Talk to former employees and watch for cultural red flags like mandatory fun or family rhetoric. Third, negotiate for more cash and less equity. Equity is a lottery ticket. Cash is guaranteed. Unless you're one of the first 10 employees, your equity stake will be so diluted that even a successful exit might not be life-changing. Fourth, maintain your skills and network. Don't get so absorbed in the startup that you lose touch with the broader industry. If the startup fails, you need to be able to land on your feet quickly. Fifth, document everything. If you see financial irregularities or ethical problems, keep records. You might need them later if you decide to blow the whistle or if there's litigation. If you're a founder, here's what I want you to hear. Build a real business. Focus on unit economics and sustainable growth. Don't chase valuation for its own sake. Don't use creative accounting to hide problems. Don't create a cult-like culture to prevent dissent. Be honest with yourself about what you're building. If you're running a real estate business, call it that. Don't pretend to be a tech company to justify an inflated valuation. There's honor in building a solid, profitable business, even if it's not sexy. Treat your employees well. Don't sell them dreams of equity riches while structuring deals so they're last in line to get paid. Give them fair compensation and realistic expectations. Build a strong, independent board. Surround yourself with people who will challenge you and hold you accountable. Don't stack the board with friends who will rubber stamp your decisions. And most importantly, know when to step aside. If the company outgrows your abilities, bring in professional management. There's no shame in being a great founder, but a mediocre CEO. The shame is in holding on too long and destroying what you built. If you're a regulator or policymaker, we need better rules. Private companies raising over $1 billion should be subject to public company disclosure requirements. Investors and employees deserve transparency. We need stronger whistleblower protections. People who report fraud should be protected and rewarded, not punished and blacklisted. We need to crack down on self-dealing by founders. Related party transactions should be heavily scrutinized and potentially prohibited. We need to reform the VC incentive structure. Management fees should be tied to returns, not just assets under management. This would reduce the pressure to deploy capital quickly without adequate due diligence, and we need better investor education. Most people don't understand how to read financial statements or evaluate business models. We should teach these skills in schools and make resources available to individual investors. These changes won't eliminate fraud. Bad actors will always find ways to deceive, but they would make fraud harder and less profitable. They would shift the balance toward transparency and accountability. The WeWork's story is ultimately a story about human nature. Our desire to believe in visionary leaders, our fear of missing out on the next big thing, our tendency to follow the crowd, our vulnerability to charisma and narrative. These aren't bugs in human psychology. They're features that served us well in our evolutionary past. But in the modern financial world, they make us vulnerable to manipulation. The solution isn't to eliminate these tendencies. That's impossible. The solution is to be aware of them, to recognize when we're being influenced by cognitive biases, to have systems and processes that counteract our natural inclinations. That's what forensic accounting does. It provides objective analysis that cuts through the emotional and social factors. It forces us to look at the numbers, not just the story. It gives us tools to protect ourselves from our own psychological vulnerabilities. And that's what I hope you take away from this episode. Not just the specific details of the WeWork fraud, but the broader lessons about how to think critically, how to analyze objectively, and how to protect yourself in a world full of charismatic con artists and inflated valuations. The next WeWork is out there. The next Adam Neumann is pitching investors right now. The next $47 billion fraud is being built. But you don't have to be a victim. You have the tools. You have the knowledge. You just have to be willing to use them. Read the silent ledgers. Trust the numbers. Ask the hard questions. And have the courage to walk away when something doesn't make sense. That's how you protect yourself. That's how you make better decisions. That's how you avoid being the next cautionary tale. Thank you for watching Silent Ledgers. This has been episode 5, The $47 Billion Deception. If you found this valuable, please like, subscribe, and share. Leave a comment with your thoughts or questions. And join us next time when we dissect the FTX collapse and show you how $8 billion vanished in less than a week. Until then, stay skeptical, stay informed, and keep reading those ledgers. The truth is always there. You just have to be willing to see it.